many investors are asking themselves a key question. Do the global equity markets have further potential after the strong first quarter of 2019? In the next few minutes, I would like to talk to you about this. The moderate words of the US Federal Reserve in recent weeks have led to a significant decline in yields on the bond market, and this in turn has boosted the stock markets. Through this, all fears of interest rate hikes were priced out. However, this begs the question, does this clear the way for further rising stock markets? I would like to respond to this based on 3 points. Point number 1 is the valuation, point number 2 is the world economy, and point number 3 is the stock market cycle. A closer look reveals that the stock markets are not currently overvalued. Both Europe and the US are in line with the long-term average and should still have potential due to the extremely low interest rates. The global economy is important for the further development of the stock markets. We are observing a recovery in early economic indicators. While the US has never been particularly weak in economic terms, China is beginning to recover, and there are also positive trends in Europe, which should continue to support the stock markets. On the question of further developments, it is worth taking a look at past cycles. Of course, there are signs of fatigue after 10 years with more or less rising prices, but there were 2 cycles in the past that were more pronounced overall, and that at around 20 years each lasted longer than the current cycle. The first cycle lasted from 1949 to 1968, and the second cycle from 1982 to 2000. When we compare the current equity environment with these 2 cycles, it is apparent that today equities have even more potential, especially if interest rates remain low. To sum it up, all 3 factors, valuation, the economy, and the cycle, favor stocks, and as a result, these have the potential to rise further. When we compare them with interest rates, stocks offer by far the most attractive risk-reward profile. However, we always need to keep in mind that the stock market does not only move in one direction. Volatility is with us, and it is here to stay. We need to view volatility as our friend, not as our enemy, as only volatility offers a way to buy stocks at attractive levels. In the ethna dynamisch, we want to actively take advantage of the opportunities offered by further equity price movements. This is why we have increased the equity quota of the fund to more than 50%. If volatility rises, our protective put strategy offers a safety net and keeps the fund price fluctuations low. With this positioning, we are confident that the ethna dynamisch can continue to offer a risk-controlled access to global equity markets for both, for newcomers and for experienced investors.